The next report we are going to see is the cash flow statement. What is a cash flow statement? A cash flow statement is basically a report that shows that how much money has moved in and out of a business over a period of time. We have three main financial statements: the P&L, the balance sheet, and the cash flow. Cash flow is of utmost importance because as an FP&A analyst, when we prepare the financial modeling, we do something known as the project cash flow projection, where we also showcase the discounted cash flows. So while it is important for you to understand the P&L and balance sheet, understanding of cash flow is a must. All right. Cash flow statement can be prepared using the direct method and the indirect method both. Indirect method is more common, more popular, simply because it takes into account, it starts with the net profit. A cash flow with direct method is a simple cash ledger where you take the opening cash balance, you add in all the cash receipts, and then you subtract all the cash outflows. You just maybe segregate it between operational, investment, and financing activities. But in case of cash flow by indirect method, we don't start with the opening balance of cash. We start with the net income. We then make adjustments in terms of the non-cash items to arrive at the net cash flow from operational activities. Then the cash flow from investment activities and financing activities are prepared in the same manner, where we add the cash inflows and subtract the cash outflows. Now, what are operating, investment, and financing activities? Operating activities are those activities which are related to the company's core business operations. So they involve cash generated or used in maybe producing the goods or selling of services, these sort of activities. For example, cash received from sales, dividend income, cash paid to the suppliers for inventory. These are all form part of the operating activities. Investing activities, on the other hand, are the activities which involve either buying the long-term investments or selling the long-term investments. Investing activities are the cash generated or cash utilized in buying or selling the long-term investments or capital assets. Financing activities are those activities which are cash generated or utilized for financing the business. For example, cash received from issuing stocks, bonds, debentures, etc., or cash used, cash paid to repay the debt, to repay the bonds, those kind of activities. Understand all of this with the help of an example. So what you're seeing on your screen are the P&L and the uh, at the bottom we have the balance sheet. The planned 2025 numbers, and this is the actual numbers for 2024. So we have the P&L for these 2 years, and at the bottom we have the balance sheet for these 2 years. Now you will be using this information, this set of information, to prepare a projected cash flow for 2025. Now, this is the format of cash flow. I have listed down the entire format for your reference. Maybe in our example, we may not be using all of these lines, but then it's important for you for your understanding. So, like I said, I'll be preparing the cash flow using the indirect method. So, we'll start with the net profit. This is the profit before taxation. I would link it. I would go to the P&L. For 2025, this was my profit before taxation. Would link it, goes here. Then I would add the non-cash income and subtract the non-cash. Sorry, I would add the non-cash expenses and subtract the non-cash income from here. So I don't have very many non-cash expenses or income. I just had one non-cash expense, which was depreciation in 2025. I would link it with this. Then we come to working capital changes. So let's have a look at the balance sheet. What is a working capital? Working capital, I hope you know the formula for working capital. It's current assets minus current liabilities. Now you can either you can either make this adjustment in parts where you calculate the changes in current assets. Any change in current assets is reflected with opposite sign in cash flow indirect method under cash flow from operating activities. For example, any increase in accounts receivable is subtracted from my cash flow statement, from my net profit. Similarly, vice versa, any increase in liabilities is any increase in the current liabilities is added to my uh, uh, cash flow from operating activities. Alternatively, what I do is I just calculate a total of working capital. So my working capital for 2025 is current assets of 2025 minus current liabilities of 2025, and working capital of 2024, going by the same formula. Let me do it here. Current assets of 2024 minus current liabilities of 2024. The changes in working capital from over these 2 years would be this much. So I have working capital has increased to 2.9 million. Again, we follow, I would say, an inverse formula over here. So any increase in working capital is subtracted from my net profit. I'll do the same. Since this is an increase net positive, I would subtract. And if I have no further adjustments in terms of interest paid, income taxes paid, dividend paid, etc., this is my cash flow from operating activities. I would then take my cash flow from investment activities. Now, if you remember the exercise that we did in our budgeting, we made two purchases this year. One, the capital asset in terms of furniture, which was around 800,000. Second was a machinery, a cold storage machinery, which was around 600,000. So these two are my purchases. I would assume that I have made all of these purchases from my cash. Uh, so purchase of property, plant, and equipment, I would uh, bring it over here. And since this is cash outflow, I would subtract it. So 600,000 cold storage machinery and 800,000 furniture. This results in 1.4 million cash outflow. I'll now come to cash flow from financing activities. I have to assume that I have paid a long-term borrowing of around 2 million. This is my net increase in cash or cash equivalent, and then I would just maybe add the cash from the beginning of the period. I would again go back and take the cash of the beginning of the period. The ending balance, if I've done everything correct, should tally with my cash at the end of the period. And as you can see over here, this balance is tallying. So my working is correct. So now I can bring it in a good desired shape, and my cash flow here is ready. Okay. So this is preparation of cash flow using the indirect method.